This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Tuesday, November the 11th, 2014. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term confidence and sentiment. This month I'd like to cover a range of topics listed here. Let me state at the outset, this is a completely false market and risks have never been higher. This doesn't mean it won't go higher in the short term. As a matter of fact, I expect higher highs in 2015, though the fundamentals won't support this view. So let's talk about what is going on and why it would feel that way. I have written extensively and talked about here in these monthly updates the degree to which tax-incented buybacks have distorted the equity markets. $2 trillion over a 21-month period will distort any market and disconnect it from the realities of historic valuations. There is endless proof of the degree of disconnect between earnings, valuations, and stock prices. Many analysts, including myself, have documented this over the last 18 months as things seem to get progressively worse and more distorted. The only thing that has been consistent is that stock prices just keep going up without any real correction or consolidation. The recent 9% correction, of which we forecast would be held to no more than 8%, is nowhere near what it needed to be. When markets behave in such a consistent manner, whether founded or unfounded, for such a long period of time, complacency and excess risk-taking enters the equation. This is what has occurred. The degree of excess risk-taking is something we haven't seen before, and I will include the 2000 dot-com bubble in that statement. I lived through the 1986, 2000, and 2008 crashes, and the excesses are worse today than I saw then. But again, that doesn't mean it's going to imminently collapse. There is an old adage, as old as the modern-day stock market, and the modern-day stock market is really marked by the U.S. Federal Reserve being created in 1913, and that adage is, don't fight the Fed. Today, that statement takes on an even greater and heightened meaning. We now have the Federal Reserve controlling and manipulating the financial markets as an instrument of the government's macroprudential strategy of financial repression. Chairman Yellen and Vice Chairman Stanley Fischer have both spoken about the implementation of this strategy without giving specifics. It is a strategy of regulations and financial controls. It's well documented, it's well understood in terms of policy format. This policy strategy penalizes savers through negative real interest rates and forces investors to take on more risk for ever smaller returns. To successfully implement it, many things must occur, which I'm not going to get into here, but which I discuss extensively in the series of macroprudential analytic interviews under the series titled Financial Repression Authority, which I have been conducting and are available free at GordonTLong.com. From a stock market perspective, what you must remember is that it is small compared to the bond and currency markets. The global equity markets approximate $60 trillion. The global bond market approximates $100 trillion. Meanwhile, currencies trade 5.2 trillion each and every day. Currencies effectively drive the bond market, which drives the equity markets. Equities are basically the flea on the dog's tail for the big money the government is trying to corral here. The markets are being manipulated through the actions and policies that impact the global currency, debt, and credit markets. This doesn't mean there aren't things which the Fed must orchestrate in the equity and gold markets to keep the whole financial repression gig going. I am witnessing the Fed attempting to control the equity markets directly by basically three means. 1. Orchestrated public job owning. 2. Trading actions through Vice Chairman Stanley Fischer's management of the infamous Plunge Protection Team, or I'll call it the PPT, and coordinated global central bank and government announcements. Most recently and blatantly, we had Fed Governor Bullard making highly visible statements at very precise times, calculated statements, which have supported the Fed's macroprudential strategy implementation. Bullard's job-owning, with very little actual substance, recently orchestrated a market slide and violent rebound. It produced the resulting fear which drove money into the safety of bonds and thereby further assisting in helping the government reduce its cost of debt. It helps it sell new debt, and it helps it roll over existing debt, all at unimaginably low rates for the risk that is being taken. I have previously shown in other presentations and reports how it appears the Fed is using options and derivatives buying to move the equity markets through this PPT group. The discount agreement with the option clearing exchanges, and I have shown the actual documented contract previously, is evidence of that. The facts can't be any clearer short of seeing the New York Fed's 700 newly hired traders placing and making the actual trades. But this is insufficient when we are talking 60 trillion in globally traded equities. It requires coordinated job owning and announcements, and we certainly have seen those recently. How about the Bank of Japan's shocking Halloween announcement? Or ECB President Mario Draghi's $1 trillion euro asset buying announcement? Both shocked the markets and catapulted them violently upward. Who could possibly afford to stand short in front of this cannon fire? Precisely the objective here. But with all this manipulation and game playing, something just isn't right. And it's pretty easy to see if you actually care to look. Markets are not working as they should, and the divergences and anomalies are becoming questionable to even the most conservative investor. For example, when the dollar strengthens, U.S. stocks usually weaken. It isn't just that earnings are impacted, but also because it takes fewer dollars to buy the same basket of stocks. But this is not what is happening in a big way. I just can't remember this happening for such a sustained period of time. We see commodity prices falling significantly along with the global GDP forecast. This is normally a clear signal that overall global demand is falling. Top-line corporate sales and revenues are falling, as would be expected as a consequence. However, stocks are going up and keep going up. We see breadth and internals not working with stock prices. We have the New York Advanced decline falling, but stocks rising over a protracted period of time. This just doesn't happen in a healthy and naturally functioning market. It happens in distorted and manipulated markets. I have shown and talked about a long-term megaphone top pattern we are putting in. I thought it was interesting that the short to intermediate term charts are now exhibiting exactly the same pattern. Fractals are something to watch for in markets. They are common. They often give you an indication of what to expect as they repeat themselves at various degrees of scale. We might expect a consolidative correction based on this fractal pattern. It may be signaling a year-beginning Q1 sell-off, tax gains therefore being deferred, before heading higher into our predicted Q3 2015 ending highs. Let's look at another repeating pattern. This is a comparison of the run-up to the 2007 high compared to today. I have marked the pattern to better see the similarities. I've mentioned a couple of times you need to pay attention to the currency market changes. We are presently seeing what I call seismic changes in this arena. The yen has broken a nearly 30-year trend support line. Currency markets tend to stay in trend, and when they reverse, they stay reversed for considerable time. The US dollar has also broken a 30-year overhead trend resistance line. It also broke a 12-year and an 8-year trend line. The close-up 8-year detail shows the US dollar has broken out of a protracted wedge. This violation forces actions to be taken. Considering the US dollar carry trade is now well north of $3 trillion, with $2.3 trillion freshly minted in emerging markets over the last 5 years, this is a problem. The cardinal rule of the carry trade is to always borrow in a weakening currency. The bet has been on a weakening US dollar. The $3 trillion is presently on the wrong side of the carry. This is now causing short covering in the US dollar and no doubt contributing to this rapid run-up in the US dollar. All of this could be just considered heightened market worries if it wasn't for earnings rapidly collapsing. Top-line growth has been a problem for some time, having fallen to a Q3 growth of 3.8% from a 5-year average of 4.8% and 4.4% in Q2. The last time stocks were pricier than today, revenue growth was 7%. Never forget that gold is the enemy of fiat currencies. Everything must be done by issuers of fiat paper currencies to keep gold prices down, or the whole gig comes apart. It's a confidence game. It's confidence that you believe there's value or store of value in that paper product, no matter how much they print. The paper price of gold has been well controlled, but not the physical. Continuous 1 a.m. in the morning dumps of high quantities of contracts on little to no volume are taking care of this. Who sells large volumes in the middle of the night into no liquidity unless they're desperately wanting to drive price down? Surprisingly, this all may be on the verge of changing, according to Bank of America Merrill Lynch's McNeil Curry. The technicals are telling him an interesting story. Maybe investors are losing confidence in the central bankers, central planning, and all the games so obviously going on. Maybe they're getting nervous and cautious. In real terms, our long-term MTOP we showed last month is quite clear. The right-hand side of the M in the S&P 500 is presently being put in. In my estimation, this will take until 2015, maybe 16, to complete. This chart shows the MTOP in nominal terms, as represented by the Dow Jones Industrial Average. Here we are on the left side of the MTOP with a possible consolidation correction shown going forward. There is a chance that the consolidation may be shallower than this chart would indicate, and as I indicated, the last minor correction we had in September, October happened that way. It will depend on how the central banks react to the looming impaired collateral value. That's the Achilles heel here. We are at historic extremes by almost any measure. I personally do not believe it is different this time. These are the most dangerous words an investor can use. It is different this time. Certainly, betting against the Fed is a risky proposition. However, soon the public will realize that the emperor has no clothes, and things will get interesting fast. All the false beliefs and confidence in the games the central bankers have been playing will end abruptly. It always does. The question is only when. You buy insurance, hoping to never use it. Maybe it is time to buy flood insurance. Though the market water is rising, for some likely manipulated reason, flood insurance keeps getting cheaper. Go figure. Just maybe this painting of the tape by the Fed has given you the opportunity that seldom comes along. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2014 be an outstanding investment year for you.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.